Hello friends. At every stage in life, you need to learn how to balance a lot of things. Whether it is your study and playtime during childhood, or as you get older, balancing your personal and professional life takes a lot of efforts, right? Similarly, to reach our investment goals, having a balance of equity and debt is very important. But guess what? It doesn't take a lot of efforts because hybrid mutual funds have got you covered. These funds are great for investors who want exposure to both the worlds of equity and debt. According to SEBI, there are 7 major categories of hybrid funds. Let's look into each of these 7 categories and know which is the most suitable hybrid fund for us. Our first category is the conservative hybrid fund. Conservative hybrid funds are designed in a way to give importance to the safety of your capital. These mutual funds have 75 to 90% of their investments in debt instruments and the remaining 10 to 25% in equities. As these funds have most of their investments aligned towards debt instruments, they make sense for conservative investors who want to ensure the safety of their capital. And as they also have a small element of equity, you can expect them to generate a little higher returns than a fixed deposit. Conservative hybrid funds are taxed like debt instruments, which means the long-term capital gains are at 20% with indexation benefit, and the short-term capital gains are taxed as per the applicable tax rate of the investor. Our second category is the balanced hybrid fund. As the name suggests, the balanced hybrid fund has a balanced allocation in debt and equity investments. In this mutual fund, the fund manager invests about 40 to 60% of their investments in debt or equity at any given point in time. If you're someone with a moderate risk profile who doesn't want to take too much risk but also doesn't want to invest too conservatively, the balanced hybrid fund category could be a great fit for you. Balanced hybrid funds have a taxation similar to debt instruments. Our third category is the aggressive hybrid fund. An aggressive hybrid fund is aggressive in nature as it invests almost 65 to 80% of its funds in equities and the remaining 20 to 35% investments in debt. This fund is suitable for investors with an aggressive risk profile who are comfortable with a larger exposure to equities and most importantly have an investment horizon of more than 5 years. Aggressive hybrid funds are taxed like equity fund with 15% short-term capital gains and 10% long-term capital gains. Our fourth category is the dynamic asset allocation fund or the balanced advantage fund. If you are one of those investors who wants to invest in equities but are afraid of the market volatility, then the dynamic asset allocation fund is the most suitable fund for you. Every fund manager has their own valuation model based on different parameters, which helps them decide when is the right time to increase investment in equities or reduce them. So when the overall markets and economy is in a positive trend, these funds will increase their equity allocation, and when there's a downfall, they will decrease it. And that's why these funds are flexible in nature. Not sure when is the right time to buy or sell equities? Leave it to the dynamic asset allocation fund. Our fifth category is the multi-asset fund. We all know that every asset class performs differently in various economic phases. Whether it is debt, which was a top performer during the dot-com crisis, gold during the 2008 subprime crisis, or even equities during the post-COVID rally. Multi-asset fund combines a bunch of these asset classes to prepare a diversified portfolio. These asset classes majorly include equity, debt, and gold, wherein the fund manager invests a minimum of 10% in 3 different asset classes. Recently, fund houses have also added international equities and real estate to multi-asset funds. Multi-asset funds have a taxation similar to debt instruments. These funds are suitable for investors with a slightly low risk appetite and who want to build their wealth with stability and diversification. Our sixth category is the arbitrage fund. The beauty about arbitrage funds is although they invest anywhere between 0 to 65% in equities, the volatility and riskiness of this fund is not similar to that of an equity fund because some portion of the investment follows an arbitrage strategy. An arbitrage strategy tries to generate returns for investors by capturing the price difference between the cash and derivatives market. Arbitrage funds are great for those investors who want to park their surplus funds for roughly 8 to 15 months. These funds are a great investment for the short to medium term, especially as they are treated as equity funds for taxation purposes. We come to our seventh and final category, the equity saving fund. Equity saving fund aims to generate stable returns as they invest in equity, debt, and arbitrage opportunities. These funds invest a minimum of 65% in equities, which majorly consist of arbitrage, and a minimum of 10% in debt. By investing in arbitrage opportunities, the equity saving fund turns out to be less volatile when compared to a pure equity scheme, and most importantly, they get benefit of equity taxation. The diversification benefit of these funds make them an attractive option for investors with a moderate risk profile who want capital appreciation and a steady income. And finally, here is a summary of all the different categories of hybrid funds on the basis of their debt equity allocation, arbitrage usage, as well as the taxation aspect. These were the 7 different categories of hybrid funds. In the comment section, let us know which hybrid fund category are you investing in or would love to invest in.